Everyone. This is Brad Matheny. Today is the 9th Sunday of February, Super Bowl Sunday. Let's see how things play out today. I'm seeing this word crash all over the place lately. It seems like everywhere I go on YouTube or wherever, people are talking about the markets being in a topping phase, or the markets are going to crash, or the markets are going to do this, or the markets are going to do that. And, I'm really, I'm just going to tell you that I think everybody's kind of lost their mind. Yeah, the markets are going to gyrate. Even me, I expect the markets to pull back downward into this channel right here over the next, 2, 3, 4 months and going into March, April, May. But this isn't a crash. This is a what? Even if it pulled back, it's 13 or 14%. Okay. A crash is, if we come back over here and we look at the SPY or the NASDAQ going all the way back here to these areas in 2029 or 2009 and 2000. Okay, these are crashes. Okay. A crash to me is anything greater than, say, 20%, 22%. Here we had a 83% crash in the NASDAQ. And here we had this was about a 50% crash in the NASDAQ. Yeah, 54% crash in the NASDAQ. All right, these little pullbacks over here like this, 14, 15, 16%. Yeah, a lot of people will technically tell you that it's bordering on a crash mode. Yeah, I get it. Okay, you want it to be a crash. You want someone to think it's a crash. To me, like I said, the average pullback, so average pullback in the SPY or QQQ is typically about 7.5 to about 12.5%. Anything in that range to me is what I call an average pullback. I don't expect it to be huge. I don't expect it to be massive. And you'll see these things happen in an uptrend. You can see right here, we're moving up, we get a little pullback. 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 Moving up, we get a little pullback. Every single one of these is, you can come in here and argue, oh, Brad, this was a big pullback, 16%. Yeah, I get it. It was a pretty big pullback, but the markets kept going up. And, I don't see a crash. I just don't see a crash happen. Here's another. Here's another. So, when you come over here and you look at this and you say, oh, the markets are going to crash. Yeah, okay, look at this. Where are we in this broad scope of things? Look at this. Monthly. So here's our big crash. Here's our big crash. Trying to get this data to fit. And they have literally been calling for a crash all the way up. All the way up. Market's going to crash, market's going to crash, market's going to crash. I remember after COVID getting, involved with some people on Twitter, and, there's a guy just wrote that markets are going to crash. They're talking about it's going to crash. You know what? Take a look at this, guys. Okay, so I'll use this as an example. I typically use the SPY or the Dow Jones, but we could use the NASDAQ. So it's pretty simple to see here that we've had a very big rally phase coming up out of this mode into this high, moving down into a low here that set up a new low. So let's, originate this as a pullback mode off the high, right? So now we come in here And if we're going to take a look at this, and we're going to determine how this market moves, so we're then getting a pullback low, coming back from here all the way up to here, down into a secondary low back here. Didn't quite hit this low, but came damn close in the broader scope of things, setting up what I would call a double bottom. So you have this double bottoming scenario right across this area. And again, it didn't hit a double bottom, but close enough that I would call it a double bottom. Now, from this point on, we move into our expansion phase. And the way I would mark this is cleanly on the NASDAQ, moving up into an A, B, and then we move up into our uh, C, D, and then now we're moving up into an E phase. So again, come over here and mark this as, let's call it a 0, because this is our, well, let's just call this end of a 5 wave down. Well, we can't. We'll just, so here's our pullback. Here's our rotation. This is our double bottom. And so here's our double bottom. And then we move into an A move here. And I'll resize this to 14, 16. And then we get our B move here. And then we get our C move here. We get our D move here. And we get our potential E move somewhere over here. We don't know yet. So understand that we're in a rally phase here, which is an A, B, C, D, E. In this broad expanding type of a cycle, right? We're moving into parabolic trending in this upward cycle. So, and of course, I could be wrong, but I'm just going to tell you that, the chances are that we're in a very early stage of this wave C. So wave B to C moves from basically these lows over here all the way up to these highs. And the reason I'm doing it this way is so you can see, if I mark these lows to these highs, we've got at least a move up here into 23 350, maybe a little higher, 23,500 minimum to see this move here. But now understand that we've gone through a massive, and I'm going to explain this to you, we've gone through a massive stimulus. And ZIRP, zero interest rate policy, monetary expansion, like nothing we've ever seen. Okay, we have never seen anything like the amount of money that has been thrown into the markets since this GFC right here, which is the global financial crisis. So this massive amount of money, which I'm going to do in blue, is driving this expansion wedge, this expanding parabolic curve. And what is happening in this mode is, this is my belief, is that, what we have here on this C mode, what I'm calling the C, oops. Oh, no, I want that. There we go. What I'm calling the C move right over here may actually just be the and I'm going to tell you this whole move here, A, B, C, D, E, okay, may be, depending on where E is, E could be even higher, may just be the first wave up. So again, it may just be that we are completing this massive expansionary phase up into A, pulling back into B, moving up into C. And again, I'd have to do this a little differently, because my analysis suggests that we are going to run into a pullback around this 2032, 2033 area. So again, if we were to move up into here, we would likely be moving into E, meaning the peak area over in this area, moving into consolidation into this area, moving into a breakaway trend, carrying, and again, carrying all the way up. So, of course, that didn't draw the way I wanted to. So let's try this again, finally. Rally up into this area, up into E, 2031, rolling over, rolling back, and moving into our B phase. So if this is a broad scoping move, you have an A, you have a B, and then you have potentially a C way up here. Now, a number of months back, I did a video telling everyone that the markets were going to double or triple, in my opinion, over the next 7 to 10 years. And I see no reason for the markets to actually move into a collapse phase. Even this move here, this would be considered a crash, a potential pullback crash of about 41%. I believe it's going to start somewhere around 2030, 2031. And I believe it's going to be a fairly big contractionary phase somewhere in this area, lasting maybe till 2032, 2033. So, yes, we have a rolling potential crisis mode right over here. But again, that's after the markets go from, this is the NASDAQ, 21,500, where we're at right now, maybe up to $45,000, $55,000 or more. That's doubling before we're going to go ahead and get a crash. Okay. Now, this crash is just essentially a pullback. And now I've drawn it here. We may end up getting a 20 or 23% pullback, depending on what happens. This is going to be kind of a restructuring moving into the next growth phase, which is going to be roughly from 2036, 2037, all the way out to 2050, roughly 2052. So, if I were to try to draw it, and again, I have to shrink everything up, we're going to be looking at, again, a growth phase here, moving through an A, B, C, D, E phase, moving up into this area before we get the next major potential pullback. Okay. And again, this is what I believe is likely to happen. So now you've got to remember, if this analysis is correct, by the time we get out here, I'm just going to tell you guys, by the time we get out here, I'm probably going to be dead. So I'm going to put this out here in the, internet and let you guys see how this plays out. But do not believe the crash sayers. Okay. Do not. The natural momentum of the market, the natural psychological play of what investors do is not to create a crash, is not to have a massive crash. Now, granted, things get out of line, sometimes get out of balance, and you can see a pullback. But what happens is markets then will collapse to some point, maybe 10, 20, 30%, maybe more. But then all of a sudden, the real value of the market, and the fact that the economy will continue, consumers will spend, babies will be born, cars will be bought. I mean, the idea that you're going to see some sort of a massive crash, the only way something like that would happen would be, in my opinion, one of two things. Okay. Either A, we lose two-thirds of the people on the planet or more instantly over the course of maybe a couple of years, then yeah, I can see the markets moving into a solid contraction, because we're going to lose GDP. We're going to lose demand for hard assets. We're going to have excess everything. We'll have excess cars. We'll have excess homes. We'll have excess food. We'll have excess everything. I mean, literally, if we were to lose two-thirds or three-quarters of the people on the planet, we're going to be looking at the markets revaluing to the downside, probably going back 30, 40, 50 years to something more capable, because, what's the value of a house when there's, 400, 500 million of them, 700, maybe 3 billion of them sitting empty around the world because people are no longer around to occupy them? What's the value of a car when, there's 10 empty cars for sale for every one that's actually needed, or 20 empty cars for sale when there's only one that's actually needed? Food at the same point in time. We're producing food for, 6 billion people on the planet generally. If we were to lose two-thirds of them, we'd have more food than we know what to do with. I mean, literally, it would be rotting before we could eat it because we just don't have the capacity to repopulate fast enough. Now, the second major issue that could cause a big issue here would be some sort of a massive financial system implosion. At this point, the US is still the dominant market, but we're much more interconnected globally than we were back in 2000, 2008. So it would have to be something on a global scale basis that collapses the financial system. And again, that would be a short lived event, in my opinion, because the true value of hard assets, whether it's in, widgets or in dollars or in, who knows, Rupel or token or, I don't know, Pokemon cards, whatever, it's going to have a value, a level. It's going to come to some fair value level. So even if we did see a massive financial collapse without any real loss of population, substantially, fair value is going to come into play. Corporations are still going to be operating profitably, and some sort of monetary process, meaning a dollar or a credit note or a debit note or a Pokemon card, whatever. I don't care what you call a currency. It's still going to be of some value that is going to be manageable and tangible and chartable. That is going to replace whatever currency or financial system collapsed. So if the dollar collapses, we'll go back to gold and silver. If gold and silver collapses, we'll go to something else. Maybe it'll be digital currency. I don't know. But ultimately, the only way I can see a collapse coming is if either society blows itself to oblivion, knocking out half or two-thirds or three-quarter of the population, or we end up in some massive unraveling scheme where, we completely destroy social order and financial order in the market, which would cause massive revaluation. Now, obviously, the loss of employee or people population would be the most dastardly. I mean, that to me could set things back literally decades, and you have to be prepared for something like that, because what happens when you get into a scenario where the entire system is built on, hypothetically, in our I use the automotive examples all the time. So imagine it's an engine. The entire world economy is an engine, and it's running, say, at 12,000 rpm, and it's consuming x amount of fuel every minute, and this is where we're at right now. So this would be, right here, right where we're at right now, would be, call it 12,000 RPM, and say it's consuming, let's assume it's consuming 120 trillion in monetary fuel every year, and its output is GDP is 140 trillion plus. Okay, that's where we're at right now with 6 billion people and global interconnected economy. If we were to lose the population, half the population or two-thirds, I could see the RPM being cut down to 3 or 4,000. I could see consumption of monetary policy being cut by maybe 80%, 85%, going down to maybe 10 or 20 trillion. I could see GDP going down to maybe 10 or 20 trillion, 25 trillion on an annual basis. That would take quite a while. You would have to think how much time it would take to repopulate the growth. You talking maybe 100 to 200 years to repopulate everything, to get back to a point where we have 6 billion people on the planet. Remember, or what do we have now? 8 billion? So hypothetically, when you look at things from a broader context, unless we have a big disruption, unless there's a major collapse, this is what you're looking at. You're looking at a phased contraction right here in 2030 to 2031, maybe 32, maybe 33. And then you're looking at a secondary phased contraction back over here, which may last into 2057, 2058. And again, you're looking at a pretty common kind of a rally. And of course, in these areas, you look 23% pullback. If my drawings are accurate, I don't know that they will be. 18% pullback. These still don't qualify as crashes. They're going to be big numbers, yeah, because when you get up into 80,000 or 140,000 on the NASDAQ, a pullback of 10% is 14, 15,000. So you're going to get these pretty big pullbacks. They're not going to be crashes. You're looking at a rally phase that's going to move up here into this A pattern, potentially pull back into this B, move all the way up potentially into this C pattern here, which would be consistent of A, B, C, D, moving up here to an E. And of course, because we're up at this C pattern here, I want you to remember that we're now working on the next phase, which would be an A, B, C, D, E. And again, that would move us up through a potential expansion phase, maybe not quite that high. So maybe, let me try to draw it again. So maybe something like this. And this is going to be our C pattern here. This would be our D here. And this would be our E up here. Now, what are these waves? Brad, you don't understand what these waves are. Okay, let me explain. Price moves in kind of a price structure. Typically, these waves form in either a single wave like this or an A, B, C wave. And this should be done in more of an equal form, but I want you to understand that you could get that or an A, B, C, D, E. These are called Elliott wave structures. And they work up or down. Okay, so you can get the same structure going down. I'll do this in red. You can get the same A, B, C moving down, or you can get the A, B, C, D, E moving down. Those are the structures. Now, you can look up Elliott wave on Google to try to figure out the generic rules of the system, but I'm trying to explain to you that these people that are out there calling for this consistently have absolutely no clue, in my opinion, what they're doing. They're just using clickbait to try to get you to click on whatever they're trying to sell you. The markets, I don't believe the markets are going to crash. I think that the crash that we had in 1920 was due to uncontrolled, really uncontrolled. 1929 was due to uncontrolled exuberance in the 1920s, pushing the markets higher and higher and higher. We do have a little bit of that happening right now because of the zero interest rate policy and the massive stimulus policy. I don't believe that we're going to see any real issues of that because the crash that occurred in 1929 was, uniquely an American process. It didn't happen globally. There were not a lot of globally interconnected banks and interconnected economies at that point in time. the global financial crisis that happened in 2008, 2009, and bottomed in 2010 was the closest thing that we got to a global kind of financial crisis event where the US led the event, but it affected international banks because of the exposure of US markets to these international banks. Now, I believe that the only thing, this is my opinion, the only thing that can cause any type of massive crash is what the two things I mentioned. Some sort of a real global financial market disruption, and it would have to take out, you know, half the globe, more than a third of the globe, and it would have to be a real destructive process. Think nuclear war, think asteroid hitting, something. It would have to be something very massive because the global economic system can absorb right now, multiple trillions of dollars in potential waste. If you come over here and you look at uh, global GDP, there we go, new capital for this one, 2021. Well, this one, fine. So here's a global GDP map. Let me try to shrink this down. There we go. And so now I want you to realize, you know, if China and the US and Germany and France, the biggest economies on the planet, and Japan were to get hit by say 20, 30% drop in GDP, yeah, it would hurt. The other markets would probably see something similar to that. But you're talking again, a point four, a one, let's do them by 10%, right? So bring out a calculator and drag it out of the way so I can do it quickly. Oops, come back. I need my calculator. So 16.8 is China, plus 5.1 is Japan, plus 22.9 is the US, plus 2.9 is France, plus 4.23 is Germany. So times 0.1 would be 5.1. So a 10% drop in GDP would be 5.1 trillion. Whereas total GDP for the world, you can see, is a couple hundred, probably 140, 160 trillion. Let's see if it has it on this. Total GDP, the $94 trillion. So $94 trillion economy in one chart, theoretically. And again, this is 2001. Yeah, 2001. So we're even higher than that. We're probably about 110, 114% or $114 trillion total GDP. But again, even if we were to see a 10 or a 20% GDP drop, that would theoretically drop stock market values by somewhere between maybe 20 to 35, maybe 45% on a devalued forward expectation. It would not be massive. It would not be really excessively massive from a structural content. And again, a 40% drop, if you were to take a look at any of these numbers, even where we're at right now, a 40% drop would put us down in about an 8,400 point drop. So we would go from 21,500 down to about, do the math, Brad, about 14,000, 13, 14,000 on the NASDAQ. And that would have to be if the entire world lost 20% of total GDP output. Think about what that would take to make it happen. It's ungodly. So these crash people, I want you to understand, don't know what the heck they're talking about. The market's not going to crash. The only way it's going to crash is if we have some sort of a major event, and we're going to go through cycles. Yes, we're going to go through pullbacks. Yes, these pullbacks are going to be associated with society restructuring and rebuilding, because what was back over here, remember, guys, you know, so I'll give you an example. If you were born in the 1940s to 19, call it 70s, you are now considered elderly or going into elderly stages. You're the older generation. If you were born between 1970 and say 2000, you are the current, let's call them middle-aged adults in the world. And if you were born between 2000 and 2025, you are the next generation that's coming up. Okay. So again, we are going to restructure because the generation that was born, the baby boomers in this area, we are now the old generation. We're moving out, so to say. 1970 to 2000, that's the middle generation. That's where we're headed now. These are the people that are taking over. These are the people that are going to build the next great economic boom cycle. And then in about 30, 40 years, these people will be the middle-aged people that'll drive us even further. So again, you must understand the whole concept here. The wealth that was generated in this generation and the previous generation is going to get transferred down to this younger generation in here, as long as nothing goes haywire. And then that wealth will get transferred down into this next generation as long as nothing goes crazy, which is why we have this long-term structure playing out. And remember, I will be dead sometime over in here. So you guys, that's me, hypothetically, I will be dead and you guys will carry forward. Okay. So understand, I think we have a very big window of opportunity here going forward the next 20, 30 years. We have this one major pullback area between 2031 roughly and 2033, something I think we all need to be aware of. But I do not see a crash. Everybody that's talking about a crash right now in this area, everybody that's telling you that the market's going to crash over here right now is lying. They're basically feeding you a bunch of crap, telling you that the markets are going to crash, when if you understand the total capacity of the market and the fact that it's globally interconnected, you need to understand that it takes something massive in order to cause a global market crash. And even these little pullbacks, Fed raising interest rates. Oh, concern, concern, concern. It pulled back 30 some percent. Yeah, we need that. And we could get another 30% or 25% pullback somewhere up here. And would that be a crash? No, folks. Crashes are when we start getting into the 45, 55, 65, 75% crash. That's a crash. Okay. This was a mild downturn leading to, now you have to remember, okay, Brad, well, let's talk about how much it crashed. Everybody's been calling for a crash since well before COVID. Yeah, I know. Let's just mark the COVID price here up to where we're at right now. The NASDAQ's gone up 138.6% while everybody's been calling for a crash. You tell me. It's gone up 138% in 5 years. Is that a crash? That's not a crash. That's a massive rally phase. Okay. And that's what I'm trying to tell you. We're in a rally phase. That rally phase will continue. There will be pullbacks. But every time all these people have been telling crash, 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 we're in a stage 22 crash. We're about to roll over. Oh my God, you don't know what's going to happen. Yeah, look at how right they've been. Where's the crash? Where is it? Back over here. Look back over here. Where's the crash? The markets since the dot-com bottom or the global financial crisis bottom have gone up 2,000%. Where's the crash? Okay, there is no crash. Okay, there is no crash. Nothing like we had back over here, and nothing like we had back over here. Both of these were massive on the NASDAQ. They're smaller on the SPY. So again, be aware of what you're seeing with all these crash dummies. I call them crash dummies because they're out there trying to sell clickbait. They're out there basically trying to tell you that, oh, the market's going to crash. You don't know what's going to happen. You need to protect your assets. You know what? I'll tell you, if you really want to follow me on my videos and pay attention, I'll tell you what I think and when I think something like that's going to happen. Like I've already told you back out here, end of 2030, early 2029, you better be paying really close attention to what I'm saying if I'm still here. But long and short of it, I see nothing but upward trending here. Yeah, we're going to get a little pullback. You want to know why? Because we're in this phase here, and I think we're going to see a kind of a pull like this. This is how this move is going to look. Something like that. And that means we're going to get these moderate little pullbacks, and you better be aware and prepared. But these little pullbacks here, yeah, crash 16%. What a crash. Oh my gosh, 7, maybe 8, maybe 9%. What a crash. I mean, these are good for you to take opportunity on, but they're not a crash. This is more of a crash, and this at 40%, I can call this technically a crash because it's beyond the 25% limit that the markets generally hold. A crash typically is 25% or more from the previous high or low. So really it's, when you get into 25%, 35%, 45%, that's a big crash. So anyway, I just kind of saw all these crash indications coming up. I'm getting emails from people. It's going to crash. So and so said it's going to crash. I watched a video the other day. Oh, we're in a stage 14 crash mode. We could stay in this mode for years. Yeah. Meanwhile, the market goes up 200, 300, 900%. Look, pay attention to what's real and learn how to become a better trader, learn how to read the data. We are, yes, we're going to roll. We're going to see 10, 8, 10, 12, 15% rolls in the market. That's common, very common, like I'm trying to tell you. But be aware that you're not going to probably see a massive crash unless something major happens. And that was the point of this video. Okay. Now, just for the heck of it, I'm going to leave you with this because you know what? Long after I die, someone will be able to pull this up and someone will go, hey, you know, this guy told us it wasn't going to crash way back in 2025. And this guy drew this out and look at what it did. And if it follows it perfectly, I'd be surprised personally, but I'm giving you the information to figure out what to do and how to really make your own decisions instead of reading all the crash dummy data. All right, guys. Happy Sunday. Let's get some Super Bowl parties going. And I know who I'm rooting for. Let's just say they tend to wear red. And we'll go from there. Talk to you later.